Good afternoon, everyone. Thank you for joining us today. I'm Zach, the Outreach Coordinator here at the Taxpayers Help Center, and I'm excited to be here to talk with you about how IRS debt can ground your U.S. passport. Fun fact, did you know that owing the IRS can keep you from traveling abroad? Under the FAST Act of 2015, if you have a seriously delinquent tax debt of over $64,000, the IRS can certify your debt to the State Department, and this could result in your passport application being denied or even having your current passport revoked. So tax troubles may not just hit your wallet, but they can also ground your travel plans. So stick around to learn how you can avoid these unexpected travel restrictions, understand what qualifies as seriously delinquent tax debt, and find out what steps to take if your passport is at risk. The Taxpayers Help Center is a nonprofit 501c3 organization in Northridge, California. We operate two tax clinics, the first of which is our low-income taxpayer clinic, where we help taxpayers resolve their tax disputes with the Internal Revenue Service. And the second clinic we operate is our volunteer income tax assistance, VITA clinic, in which we help prepare income taxes for free. And additionally, we are an IRS authorized certifying acceptance agent for individual taxpayer identification number applications. So if you'd like to connect with us, you may do so through email at info@taxpayershelpcenter.com. Additionally, you can reach us at Facebook at Taxpayers Help Center, Inc., a nonprofit organization. We have our location at 9029 Reseda Boulevard, Suite 209, Northridge, California. And then our website is also listed here along with our telephone number. Also, if you have any questions at any time during the presentation, you can email us at info@taxpayershelpcenter.com and a tax professional will get back to you. The Taxpayers Help Center helps taxpayers both locally and beyond. So since the services we provide are free, donations are important in supporting us and in helping the reach of our services. Any monetary donations are greatly appreciated. Additionally, those who can volunteer their time or expertise or spread awareness are a great help. So if you would like to make a monetary donation, you may do so at taxpayershelpcenter.com/make-a-donation, or probably the easier way is if you just go to taxpayershelpcenter.com and click on the Make a Donation tab, which I have highlighted here in red in this image. And again, anything is greatly appreciated as these donations allow us to do what we do. Today, we are going to discuss how IRS debt can ground your U.S. passport. We will address the following topics. What is a seriously delinquent tax debt? How the IRS refers tax debt to the State Department. What you need to know about passport revocation. Preventing IRS referral to the State Department. Legal remedies and resolution strategies. What to do if your passport is at risk. And then we'll go over some real-life case studies. So first, let's talk about the FAST Act of 2015. On December 4th, 2015, the FAST Act introduced Code Section 7345, which mandates the Department of the Treasury to inform the Department of State when an individual is certified as having a seriously delinquent tax debt. This certification or its reversal can only be made by specific IRS officials, including the Commissioner of Internal Revenue or a designated delegate. When the State Department receives such a certification under Section 7345, it generally denies the individual's passport application for issuance or renewal and may also revoke or limit an existing passport. The IRS and State Department began enforcing these rules in January 2018. And we'll get into what seriously delinquent tax debt actually is. So don't worry if that's not a familiar term to you. So now let's talk about the People First initiative. It was a critical policy by the IRS designed to assist taxpayers facing financial difficulties. The initiative temporarily suspended certain enforcement actions, including the certification of seriously delinquent tax debts that could lead to passport revocation. This meant, under certain circumstances, the IRS held off on pursuing aggressive collection measures. The initiative was particularly significant during the COVID-19 pandemic, providing taxpayers some breathing room to manage their obligations. The goal here was to give taxpayers a chance to address their issues without immediately facing severe penalties or actions like passport revocation. Let's discuss what constitutes a seriously delinquent tax debt under the IRS guidelines. This classification isn't just about owing a large sum of money. It's a combination of factors that show a taxpayer's failure to comply with tax rules. As of 2024, the threshold for a seriously delinquent tax debt is set at $64,000, and this is adjusted for inflation. This amount includes not only the initial tax owed, but also any penalties and accrued interest. So a taxpayer who initially owes $45,000 could see that amount increase to over $64,000 if the debt is left unpaid and interest accumulates. To enforce compliance, the IRS may take significant actions like filing a notice of federal tax lien or issuing a levy. These steps aren't immediate. They come after multiple attempts to contact the taxpayer and resolve the issue. Several situations can trigger a debt being classified as seriously delinquent. One major trigger is the failure to file required tax returns. Imagine a taxpayer who earns income but ignores repeated IRS notices to file returns. That taxpayer could face this serious classification. Another trigger is defaulting on an installment agreement. If a taxpayer sets up a plan to buy back taxes but stops making payments without any valid reason or communication, the IRS may escalate the situation by filing a lien. And additionally, serious underreporting of income can lead to this status. For example, if someone fails to report substantial income, the penalties can be significant enough to push their debt into the seriously delinquent category. These examples emphasize the importance of staying compliant with tax obligations. Ignoring these issues can lead to severe consequences, including passport restrictions or enforced collections. The IRS does provide opportunities to resolve these debts, but when those opportunities are ignored, the implications can be quite serious. How the IRS refers tax debt to the State Department. So when the IRS identifies a taxpayer as having a seriously delinquent tax debt, it doesn't just handle the issue internally. The IRS has the authority to refer this debt to the U.S. State Department, setting in motion a series of significant consequences for the taxpayer. This process starts with the IRS certifying the tax debt as seriously delinquent. This certification means that the taxpayer owes more than $64,000, has exhausted most options for appeal or contest, and still has not resolved the debt. Once the IRS certifies the debt, it forwards this information to the State Department. The State Department's role in this process is crucial. It is empowered to deny, revoke, or limit a taxpayer's passport based on the IRS's certification. For example, if a taxpayer is planning to travel internationally, the State Department could deny their passport application or renewal. And in more severe cases, an existing passport may be revoked, limiting the taxpayer's ability to travel outside the United States. So, as we mentioned, the timeline of events in this process typically starts with the IRS issuing a notice of federal tax lien or levy. And if these actions fail to result in payment or resolution, the IRS moves to certify the debt. And once certified, the IRS sends a notice to the taxpayer, usually in the form of IRS Notice CP 508C, informing them that their debt has been referred to the State Department. This notice is a final warning for taxpayers to resolve their debt before facing potential passport restrictions. The State Department is then notified and can act almost immediately, depending on the taxpayer's travel status and other factors. This process can unfold quickly, leaving taxpayers with limited time to respond. However, if the taxpayer makes full payment or enters into an installment agreement, the IRS can reverse the certification and the State Department can restore their passport privileges. The key takeaway is that the taxpayer must act promptly to resolve their debts once they receive notification, as the repercussions of an action can extend beyond financial penalties to significantly impact personal freedom and mobility. So passport revocation is one of the more severe consequences of having a seriously delinquent tax debt certified by the IRS. This process is not automatic. It happens under specific conditions. The primary condition leading to revocation is when the IRS certifies a taxpayer's debt as seriously delinquent and notifies the State Department. So as we mentioned, when this happened, the State Department has the authority to revoke a current passport or to deny a new application renewal. The impact on international travel can be immediate and far-reaching. For instance, if a taxpayer is already abroad and the IRS certifies their debt, they could be denied entry back into the US without a valid passport. Similarly, a taxpayer planning a trip may find their passport application or renewal is denied. Imagine booking a long-awaited vacation or an important business trip only to find out the last moment that your passport has been revoked or renewal denied to unpaid taxes. This is a real scenario for many who fall into this category. Reapplying for a passport after revocation is not as simple as resolving the debt. The taxpayer must either pay off the debt in full or enter into an acceptable payment arrangement with the IRS, such as an installment agreement or an offer in compromise. Even then, it takes time for the IRS to reverse the certification and for the State Department to lift the restrictions. There are often delays and additional challenges, including having to provide proof that the debt has been addressed or that an agreement is in place. Reapplying becomes a hurdle, and the traveler must be prepared for extensive verification processes. Overall, the takeaway is that passport revocation due to tax debt is a significant issue that impacts more than just financial status. It affects personal freedom and international mobility. So resolving the tax debt quickly and understanding the process can prevent these significant consequences. Understanding your CP 504 notices. So this process rather is not automatic. It happens under specific conditions. The primary condition leading to revocation is when the IRS certifies the taxpayer's debt as seriously delinquent and notifies the State Department. When this happens, the State Department has the authority to revoke a current passport or deny a renewal or a new application, as we've mentioned. But so you may get this CP 504 notice. So this is a warning to intent to levy if the debt remains unpaid, and it alerts taxpayers that passport certification is possible. And then immediate payment or contact with IRS to avoid further escalation is required. So overall, the takeaway is that passport revocation due to tax debt is a significant issue that impacts more than just financial status. It affects the freedom and mobility. So it is really important to resolve this quick once you get one of these notices. Preventing the IRS from referring a seriously delinquent tax debt to the United States, or to the State Department rather, is critical to avoid passport issues and other severe consequences. So the best way to prevent an IRS referral is to be proactive about managing tax obligations. This starts with filing all tax returns on time and responding to any IRS notices or letters promptly. Ignoring these notices can lead to escalation, where a manageable tax debt turns into a seriously delinquent situation. For example, if you receive a notice about an underpayment or missing return, it's essential to address it right away rather than letting it slide, which could lead to penalties, interest, and eventually a certification of serious delinquency. If a taxpayer finds himself owing more than they can pay immediately, the IRS offers various payment options and installment agreements. These agreements allow taxpayers to break down their debt into manageable monthly payments. One of the simplest options is a streamlined installment agreement, which requires minimal paperwork and is available for debts under a certain amount. For larger debts, taxpayers might consider an offer in compromise, which is abbreviated as OIC, where they negotiate to pay less than the full amount owed. So, for example, someone owing $70,000 may be eligible to pay $40,000 through an OIC if they can prove financial hardship. Setting up one of these agreements prevents the IRS from certifying the debt as seriously delinquent and thus avoids referral to the State Department. Communication with the IRS plays a pivotal role in this process. Keeping an open line of communication helps in negotiating terms, understanding options, and demonstrating good faith in resolving the debt. If taxpayers communicate early, they can often prevent escalation and manage their debt in a way that avoids certification as seriously delinquent. Suppose there are issues with an installment plan or a temporary inability to pay. In that case, reaching out to the IRS for a temporary delay or adjustment is far better than missing payments altogether. Being proactive and communicative rather, not only helps in preventing certification to the State Department, but also minimizes the overall stress and financial strain. By taking these steps, being proactive, exploring payment options rather, and staying in communication, taxpayers can avoid the serious consequences of an IRS referral to the State Department and maintain their ability to travel freely. Legal remedies and resolution strategies. When dealing with serious tax debt, there are several legal remedies and resolution strategies that taxpayers can utilize to manage their situation and to avoid further escalation by the IRS. One common strategy is in an OIC, which we mentioned in the last slide, offer and compromise. This is an agreement between the taxpayer and the IRS that allows the taxpayer to settle their tax debt for less than the full amount owed. This option is particularly useful for those who can demonstrate that paying the full debt would cause undue financial hardship or that there is doubt as to the collectability of the full amount. For example, a taxpayer owing $100,000 might negotiate to pay only $50,000 if they can prove that their financial situation makes it unlikely that they could ever pay the full amount. Another powerful tool for resolving tax disputes is a collection due process hearing, also abbreviated as CDP. This hearing provides a platform for taxpayers to challenge the IRS's collection actions, such as levies or liens. During a CDP hearing, taxpayers can present their case, propose alternative payment arrangements, or request the IRS to consider an offer in compromise. For instance, if the IRS places a levy on a taxpayer's bank account, the taxpayer can request a CDP hearing to contest the levy and negotiate a more manageable payment plan. This hearing helps ensure that the IRS follows proper procedures and gives taxpayers an opportunity to resolve their debt without resorting to severe collection actions. For those facing issues due to errors made by a spouse, innocent spouse relief can provide a path to resolution. This form of relief is available when a taxpayer can demonstrate that they should not be held liable for taxes, interest, and penalties that arise from a spouse's erroneous tax filings. For example, if one spouse underreported income earned properly claimed deductions without the other spouse's knowledge, the innocent spouse can apply for relief to avoid being held responsible for the resulting tax debt. This remedy is particularly valuable in situations where one spouse may have acted without the knowledge or involvement of the other, creating a disproportionate financial burden. So by understanding and utilizing these legal remedies, offers in compromise, collections due process hearings, and innocent spouse relief, taxpayers can navigate their way through complex tax issues, reduce their liabilities, and find a more manageable resolution to their tax problems. Each strategy requires a clear understanding of eligibility requirements and proper negotiation with the IRS, but they offer a lifeline to those struggling with serious tax debt. What to do if your passport is at risk. If you find out that your passport is at risk due to a certification of seriously delinquent tax debt by the IRS, it is crucial to act swiftly to prevent significant disruptions to your travel plans and legal standing. The first step involves taking immediate action to address the debt. The most effective way to resolve this issue quickly is to pay off the debt in full if possible. If a full payment is not feasible, setting up an installment agreement with the IRS is another immediate step. This shows good faith in resolving the debt and can result in the IRS reversing the certification, which in turn allows the State Department to restore your passport privileges. Working with the IRS and State Department is essential in this process. Once your debt is certified seriously delinquent, you'll receive a notice from the IRS, often a CP 508C notice. Upon receiving this notice, it is important to communicate promptly with the IRS. Contact them directly to discuss your payment options or to resolve any discrepancies that may have led to the certification. After resolving the debt, request the IRS to issue a CP 508R notice, which informs the State Department that your certification has been reversed. Staying in regular communication with both agencies can help ensure that all steps are followed correctly and that your travel plans remain intact. If dealing with the IRS and State Department feels overwhelming, or if your case involves complex financial or legal issues, seeking professional help is highly advisable. A tax attorney, CPA, or an enrolled agent experienced in handling tax debt cases can provide the expertise needed to navigate these waters. Professionals can negotiate on your behalf, helping you understand all your options and ensure that any agreements with the IRS are set up correctly. For example, if you are unsure about the eligibility for an offer in compromise or other relief programs, a tax professional can evaluate your case and advise the best course of action. They can also handle all communication with the IRS and State Department, making the process less stressful and more efficient. By taking these steps, acting immediately, maintaining open communication with the IRS and State Department, and seeking professional help, you can effectively manage the situation and reduce your risk of losing your passport, ensuring that you remain compliant and in good standing. If you've resolved your tax debt issues, the IRS can issue a CP 508R notice, which reverses a certification of your debt as seriously delinquent. This notice is typically issued when a taxpayer makes full payment of the debt, enters into an acceptable installment agreement, or otherwise meets the criteria for the reversal. Once the IRS sends the notice, the State Department is notified, and they can then reinstate or renew your passport. This is the final step in regaining your travel rights, but it requires that all conditions be met and verified by the IRS. So now let's get into some specific case studies. Or actually, first, let's just go into some other ones. So let's dive into some real life case studies that highlight what can happen when tax debt leads to passport revocation. These examples show how both high-profile individuals and everyday taxpayers have been affected by this serious consequence. So one notable case involves a well-known business executive. He owed over $200,000 in back taxes, but ignored IRS notices for years. His passport was revoked when he was about to travel abroad for a major conference. This not only impacted his personal life, but also had significant professional repercussions, including the loss of key business opportunities. In another case, we have a freelance contractor who didn't file tax returns for several years, leading to an accumulation of $75,000 in tax debt. He received multiple notices from the IRS, but failed to respond. Eventually, his debt was certified as seriously delinquent, and when he tried to renew his passport for an important trip, his application was denied. This situation could have been avoided if he had taken steps earlier to address the debt. So what lessons can we learn from these cases? First, it's crucial to stay on top of your tax filings and respond to any IRS notices as soon as possible. Ignoring these communications only makes things worse, as seen in these examples. If you're unable to pay your taxes in full, setting up a payment plan or negotiating an offer in compromise can prevent your debt from escalating to a seriously delinquent status. Another key takeaway is the importance of communication with the IRS. The business executive could have avoided the passport revocation by seeking professional advice and engaging with the IRS earlier in the process. By doing so, he may have negotiated a payment plan that would have kept his passport intact. Finally, seeking professional help from a tax attorney or CPA can make a significant difference. These professionals can help you navigate the complexities of the IRS's processes and find the best legal remedies available to you. So let's go into some more specific case studies. So case study 1, Matson versus Commissioner of Internal Revenue. So let's walk through the key points. This case centers around whether the IRS properly certified Eric P. Matson's tax debt as seriously delinquent, a classification that can lead to passport revocation under 26 Code 7345, or rather Section 7345. So here's the rule. Under Section 7345, the IRS has the authority to certify a taxpayer's debt as seriously delinquent if it exceeds, I believe it is $64,000. Yeah, $64,000 as we mentioned, and involves a lien or levy, rather. This certification allows the State Department to revoke or deny the taxpayer's passport. In the application of the rule, Matson challenged the IRS's actions, claiming they didn't follow the correct procedures. However, the court found that his tax debt far exceeded the statutory limit, and all proper procedures, including notices and opportunities for appeal, were provided. The IRS presented clear evidence of compliance, showing that the certification was in line with the statute's purpose, to motivate taxpayers to resolve their debt. So, in conclusion, the court sided with the IRS upholding the certification of Matson's debt as seriously delinquent. This decision means that Matson's passport could be revoked as the debt status the debt status meets the criteria under Section 7345. So here is the second case study we're going to go into, NYE versus Commissioner of Internal Revenue. This case similarly explores the issues of passport revocation due to seriously delinquent tax debt. The key question here is whether the IRS correctly certified Daniel Olin Nye's debt under Section 7345. So, in the application of this rule, Nye's tax debt reached $99,222 to be exact, covering multiple years and involving several notices of federal tax lien and intent to levy. Nye argued that he complied with his installment agreement, but the court found that he failed to provide updated financial statements and did not meet the terms required. Despite his claims, there was no evidence to back up his compliance. So in conclusion, the court granted summary judgment in favor of the IRS, upholding Nye's certification as having a seriously delinquent tax debt. This means that Nye's passport is at risk of revocation or limitation, affirming the IRS's authority under Section 7345. The lesson here is clear. Maintaining compliance with payment agreements and promptly addressing IRS notices is crucial to avoid such severe penalties. So as we wrap up, let's recap some of the key points we've covered today about managing and avoiding serious tax debt issues and the potential consequences, such as the loss of a passport. First, we talked about the People's First Initiative and what qualifies as a seriously delinquent tax debt, and the threshold of $64,000, including penalties and interest. We went through the steps of how the IRS can refer a certified debt to the State Department, which could lead to a passport being denied or revoked. We also discussed preventative measures like staying compliant with tax filings, setting up payment plans, and maintaining open communication with the IRS. We looked at various legal remedies and resolution strategies such as offers in compromise, collections due process hearings, and innocent spouse relief that can help taxpayers manage their debts and potentially avoid severe consequences. And finally, we explored several real-life case studies to highlight the importance of proactive management and the serious impact of inaction. All these points underscore one main takeaway. It's crucial to stay on top of your tax obligations and seek help if you find yourself in trouble. So now if you need further assistance, there's several resources available. The IRS offers a range of tools on its website, including payment plan options, guidance on filing, and forms for offers in compromise. For those needing more help hands-on help, consider consulting with tax professionals such as CPAs, tax attorneys, or enrolled agents who specialize in dealing with the IRS. So with that, that's everything. Thank you all for listening. And again, since our services are free, donations are crucial for our support and expanding our reach. Monetary donations are greatly appreciated. Additionally, those who can volunteer their time, expertise, or help spread awareness are a great help. If you had any questions about anything today during the presentation, please email us at info@taxpayershelpcenter.com, and your questions will be answered by a tax professional. So with that being said, thank you all for listening and have a great day.